Hey everyone, and welcome back. In today's video, we are of course doing another episode of Stock Market Q&A for the month of October 2020. Thank you everybody who asked a question on the post on the community board. And if you're wondering how you can get a question in next month's video, all you have to do is be subscribed to the channel, hit that notification bell, and make sure you have all notifications turned on. And essentially, just before I make the Q&A video in about a month's time, which will be the next one, I make a post on the community board. And on that post, you can leave a comment leaving your questions. So that's how you need to do it. Make sure you're subscribed. But other than that, let's not waste your time with a huge intro. Let's get straight into some questions and get through as many as possible. The first question that we've got here is from Sean. With low interest rates and the fear of a stock bubble, how can families/retail investors safeguard or at least manage money? I think this is probably a big concern for a lot of people at the moment, is that the stock market is at all-time highs in the US. In Australia, we're at 7-month highs and near all-time highs. And this is all going on while we're in the middle of the worst recession that the US and Australia and many parts of the world have seen since the Great Depression in 1929. So a lot of people believe and have the idea that the stock market is in a bubble. So in other words, that it's overly expensive and that stock prices need to come down. And I think broadly speaking, that's a fair comment to make, considering prior to COVID, I think that the stock market broadly, at least in the US, was overvalued, that businesses were very, very high and not offering very good returns. And now the fact that we've just gone through a severe pandemic and we're still in the midst of the pandemic, honestly, and yet stock prices are even higher than they were pre-pandemic, I think it's not hard to argue that we are in the middle, broadly speaking, of an expensive stock market. But with that said, as an individual, there's a couple of ways that you can navigate that in order to best position yourself while the market is expensive. If you're one of the 99% of people out there who don't want to analyze individual businesses, but you want to be invested in the stock market and benefit from growth of businesses in your country over time, then you can just consistently invest into an index fund. Nothing changes. It doesn't matter if you think the market is expensive, if it's cheap. If you're buying into an index fund that tracks the whole US market, for example, or the whole Australian market, then you're essentially just wanting to consistently contribute regardless of what the price of the market overall is. You really don't need to worry about what the price of the market is overall. You just consistently come back. Sometimes you'll be buying expensive, sometimes you'll be buying cheap. And overall, if you're adding consistently over 10, 20, 30 years or even longer, then you will capture the average growth of that stock market over time. If you are one of those 1% of people who do analyze individual businesses and are trying to outperform the market, deliver a higher return than the market average over time, then even though the market is broadly expensive, there will almost always be opportunities in the market. There will be segments that are struggling while everything else is doing well. And even though at the moment, on average, the market is, at all-time highs, there are certain sectors where that is not the case. I think travel is one of them, and you can look in those areas if you have an understanding of businesses in that area, and you can find the strong businesses that have been pulled down broadly by everything in the travel sector, but does not deserve to be pulled down because maybe it has low debt, it has great characteristics about it, a great management team, and that sort of thing. And then the final thing that you want to think about in terms of protecting your wealth is to gather some kind of diversification in your portfolio. And of course, I've spoken about being over-diversified quite a lot on this channel because I think that when you're looking at individual businesses, it makes sense to concentrate your portfolio and concentrate your time and research into knowing a lot about a small number of industries. But you do need to have some level of diversification. Diversification in terms of asset classes, holding cash, holding bonds, holding stocks, holding property. Diversification in terms of the number of businesses that you have in your portfolio, not investing everything in a single business. And then getting diversification from currencies, or so having money in US dollars, Australian dollars, having stocks and bonds in US dollars, Australian dollars, gathering some kind of diversification to spread out your risk of one single asset class, or one single business, or one single country. The next question that we've got here is from Evan. I don't think I saw a spot for dividends in your discounted cash flow model. How do dividends affect how you determine intrinsic value of the business? Yeah, so the reason why dividends don't have its own place in the discounted cash flow is because when I'm doing a discounted cash flow, the number that I'm putting into that calculator, the profit figure, is cash flow for owners. And this figure is a representation of all of the money left over after A, the normal business operations, and B, after maintaining long-term assets, maintaining machinery, buildings, and that sort of thing. So all of that money left over can then be used to either reinvest back into the business to grow it. Either it can be kept on the balance sheet to strengthen the financial position of the business, or it can be delivered to shareholders in the form of share repurchases and dividends. So that cash flow for owners figure that we're putting into the discounted cash flow includes all of the money that can be reinvested to grow the business, but also money that can be distributed as dividends. So it's kind of like I'm not trying to predict how much of their profits they are going to pay out as dividends. I'm just trying to estimate the total profit figure in terms of cash, and then whether the management team decides to pay out 20% as a dividend and keep 80% in doesn't really bother me, because I know that in a great business, one way or another, if they keep it in the business or if they deliver it directly to me, it will be returned to me either as a dividend, as cash, or through the stock price appreciating, through the value of the business growing. The next question that we've got here is, what books or sources would you suggest for someone with non-accounting background to get started and understand the numbers? Yeah, that's a really good question. In terms of books, I actually don't really know too many good books. If anyone has any suggestions, leave them down in the comment section below. Personally, I learned the foundations of accounting through the university course that I studied in Melbourne. But I would suggest that you can probably find a substantial amount of information about foundational accounting just on YouTube. Things like Khan Academy, and I know there's a number of other channels that provide really, really good educational content in terms of mathematics and accounting specifically. And I'm pretty sure that you could learn everything that you would learn in first year university accounting, or even second or third year university accounting on YouTube, if you are just willing to go through the motions of watching those videos. So that's where I would start personally if I had not taken a traditional accounting course. The next question that we've got here is, what's your best advice when using qualitative analysis to help identify moats? So for those who are not aware, whenever we are trying to identify a competitive advantage or an economic moat, as Warren Buffett sort of coined the term economic moat, we have to look at the qualitative moat and the quantitative moat analysis. So first, trying to just come up with a hypothesis, trying to figure out what the advantage could be, and then looking to the numbers to see if it's supported in strong business growth. So on the qualitative side, I think the best suggestion is just to have a list of all of the major types of advantages that businesses could have. And just when you're assessing a business, go through one by one and think about whether this business has that advantage. So on that list, you will have things such as a networking effect, switching costs, a toll moat. You might have economies of scale, businesses that get a lower cost production as they get larger. There's a number of sort of major economic moats that you can sort of have in a list and try and see which, if any of those apply to the business you're looking at. That's what I would suggest. There's a great article on Morningstar about economic moats, and they have a list of 5 or 6 major types of economic moats. So I'd highly recommend you go check that out if you want to expand your knowledge in the world of economic moats. And of course, I have a number of videos about that on my channel as well. The next question that we have here is, how do you know so much about investing and finance? What is your background in this field? For example, experience, education. Yeah, so in terms of formal education, I studied at a university in Melbourne for 2 years, and I majored in finance. So I didn't actually finish that course. I did 2 years and then discontinued it. But that's kind of where I learned a lot of the foundational finance stuff, learning how to do the maths behind discounted cash flows and basic accounting, as I mentioned before, and basic economics and that sort of thing. But I think most of my understanding of investing came from my own studying outside of university. So the entire time while I was at university, and then of course since then, I was just absolutely obsessed with the world of finance. And that meant that I was reading every single book that I could find and looking up articles and investing my own money, of course, and researching companies. And through that process, I kind of fell in love with Warren Buffett's principles. I think that they made a lot of sense. sense. For someone who has quite a strong maths background, it was just at its very core, we look for businesses and we compare what we pay for them to what we can get back in the future. And the whole game of investing is to reduce the uncertainty of what we're going to get back in the future while still making investments that can deliver a substantial return. And that resonated with me quite a lot. And yeah, most of my experience just comes from reading books and learning in my own time, also university, and then investing on my own for the past few years. The next question that we've got here is, hi Hamish, just wondering if you have an opinion on writing covered calls on your share portfolio. It is said by people that you can use this strategy to make between 2% to 4% ROI, return on investment, per month. Yeah, so it's not something I personally do at the moment. And for those who are unaware, writing a covered call option essentially means that you're writing a contract that will, if the person on the other side of that contract calls that contract, you would be obligated to sell shares at a certain price. And covered just means that you already hold those shares. So for example, I have shares in Thor Industries. I could write covered call options that would obligate me to sell those shares at a certain price if it reaches that price. If it doesn't reach that price, then I essentially just collect the price that they paid for that contract. So the way that you would do this as a value investor is you would write these covered call options at a price where you would want to get out of that stock. So if it was overvalued and you had a price that you would no longer want to be invested in that company, then you could write these options. And until the stock reaches that price, you are collecting a premium. Maybe it's 1% of the price of your investment. And then if it reaches that price, you're obligated to sell, which you are okay with because you were going to sell anyway once it exceeded that price. So that's kind of one way that you can go about generating some income. I know that Phil Town talks about this quite a lot. It's not something I personally do, but when I do try this in the future and when I have some experience in this, I probably will start to talk about it on the channel. And then the final question that we had time for today is, hi Hamish, my questions are, what are the things we should notice when we start to analyze a company, how to start, methods and materials? Yep, that's all. Have a nice day, Hamish. I hope you have a nice day too. Yeah, so in terms of getting started, as I always say, think about the industries and sectors and markets and products and services that you personally know a little bit more about than the average person. Maybe you've worked in that industry. Maybe you are a consumer in that industry quite often, or maybe you're just interested in it. It's a hobby for you. So start in those areas so that you have a little bit of an edge. And then there's some key major things that are required for us to make an investment. The business needs to have at least 10 years on the stock market, 10 years of financial data. It needs to be growing its revenues, its profits, its equity, its cash flows consistently over time. It needs to be consistently profitable. So 9 out of the last 10 years need to be profitable. And in most cases, I want to see 10 out of 10 years. And even better than that, if a company has been on the stock market for 20 or 30 years, I want to see that it is never losing money in a single year. I want to see that it's always profitable. And if you find a business like that, then you can dive deeper into things, looking at the management team, see if you trust them, see if they're good at their job by looking at the return on invested capital, looking at their debt figures, looking for economic moats, developing your understanding of the business further, figuring out intrinsic value. So those are some of the things that I would look at first, and then you can dive deeper into the full analysis process in order to gain the confidence that's required in order to make really smart investments. But that is all we had time for today. And as I said at the beginning of the video, if you do want to have a question in next month's video, then what you need to do is be subscribed, hit the notification bell next to the subscribe button and make sure that you have all notifications turned on. And then in about a month's time, I'll be making a post on the community board of my channel and you will get notified and you can leave your question as a comment on that post. But other than that, hope you guys enjoyed today's video. And if you did, I'd very much appreciate it if you could leave a like on the video and of course, let me know your thoughts down in the comment section below. But other than that, hope you guys have a great day and I'll see you in the next video.